Hello, and welcome to the Investing on the Go podcast. I'm Chris Sarley, and today we're joined by Mark Wright, who's one of the co-managers of the Seneca Diversified Income Fund. Thank you for joining us today, Mark.
Hi, you're welcome.
I wanted to start by talking to you about income. You look to invest in income opportunities that are undervalued by the market. What's the rationale behind this, and did you pick up new value opportunities in the recent sell-off?
No, that's right, Chris. I mean, firstly, there's a lot of demand for income out there, and that's partly due to the environment that we're in with extremely low interest rates pretty much across the world, and also specifically in the UK, down to demographics. So we generally have an aging population that's income starved, really. And that they're especially interested in sustainable income, and that's something that we can source from the multiple asset classes that we invest in. So we invest in UK equities, equities overseas, fixed income, and what we would term specialist assets, which can be thought of as kind of alternative sources of income, be that property, infrastructure, or some kind of specialist financial vehicles such as direct lending, so stepping in where the banks aren't there. And in particular in the UK, it should be noted that high dividend yield strategies typically outperform in the long run. And I think that's for good reason, because effectively stocks that are typically on a high dividend yield are very much out of favour with investors. So it's very much a contrarian approach, and you can view high dividend yields as a kind of proxy for value, basically. So, and that's what we are at Seneca. We're value investors, so that means we're trying to buy assets cheaply. So we try and assess what their actual worth is, and then try and buy them for a price below that. We also have observed that high quality companies tend to outperform in the long run. So that's essentially businesses that for every pound that they invest in their business, they get a very high return on that. So we try and blend the two within the UK equity space. And the recent sell-off has created a lot of opportunities for us, which has been great.
I wanted to touch on a couple of the opportunities that you have sort of scooped up recently. You've recently invested in diversified gas and oil and also Purplebricks. Could you maybe take each one and just talk us through what's attracted you to each of them?
Yeah, of course. So diversified gas and oil, that was our first exposure to the oil and gas sector for a while. It's a completely unloved sector for obvious reasons in a way. You see headlines where, companies, it wasn't long ago, companies were effectively paying people to take oil off them. They weren't even charging them for a barrel of oil. They're actually paying them to get rid of it. But diversified gas and oil's a slightly different business, really. So the key thing is they're an operator rather than an explorer. So they're not, wasting lots of capital, pouring money into trying to discover new oil or gas wells. Instead, they just operate mature, predominantly gas fields, and they have very predictable rates of production. So, what's interesting is when you discover a new gas or oil resource, that well that you use to extract the oil or the gas, that rate of production will peak very quickly and then decline very rapidly. So it's not unusual for 18 months, 2 years later, that well will be producing less than half that it was at the time that it commenced production. Whereas more mature wells, that rate of decline is substantially less. So it's a much more predictable production rate. And what diversified gas and oil are doing is they're trying to buy these mature producing wells effectively from distressed owners. So they're getting hold of them at very attractive valuations. And they do something that's called forward hedging their production. So what does that mean? it means that for every barrel of oil or gas that they extract from the ground, they don't then have to go and take the price that people will see on the news or in the Financial Times, etc. They've already locked in the price that they're going to get for that gas that they extract forward for all of this year, most of 2021, and a substantial portion of 2022. So that means they pretty much know how much they'll produce, they pretty much know what price they'll get for it. So it's a very stable cash flow that it generates, and that means they can still afford to pay a very healthy dividend that's actually growing. So we managed to buy into the shares on a double-digit dividend yield, and we'd expect that dividend to grow over the coming years.
And perhaps a more familiar name, Purplebricks. What's the attraction?
Yeah, well, it's certainly a familiar name. I mean, it's one of the most recognised brands in the UK. In fact, I mean, in a relatively recent survey, it was deemed a more relevant brand than the likes of Apple and TripAdvisor, which is incredible. And that's an undervalued asset to us, that brand, that the company's worked very hard to build over the last few years. And we've actually been building a position in the company since towards the end of last year, and then continued to through the crisis. And the market presented us with a fantastic opportunity to, invest in a technology-led industry disruptor at a low valuation. So Purplebricks was previously a darling of the market, going back a few years, but the company very quickly took market share in the UK. So it's actually the UK's biggest estate agency already, despite the company only being about 6 years old. Mm-hmm. And they tried to take that model overseas to places like America, Australia. But to be honest, they overextended themselves too quickly and underestimated how easy it would be to replicate the UK model in those markets. So the shares kind of got up to around 500p. It was clearly not a success in Australia and America. So the market fell out of love with the company. And we've been able to buy shares as cheaply as 30p through the crisis. And what people forget is that the company's got net cash on the balance sheet. There's no debt in the business. So it's extremely resilient during the downturn. And at one point, the valuation placed on the business, just the cash on the balance sheet, must have been close to a third of that total valuation. So you weren't really paying much for the actual business and the future cash generation potential. And, we observed very closely, the number of listings that Purplebricks achieve. And they were one of very few estate agents that were still open for business during the pandemic. You'd be surprised how many people were still instructing Purplebricks to list their property for sale. And, and the company gets paid when it lists that property, not when it sells it. So we absolutely thought it was a huge opportunity to add to the position during the crisis. And I think a lot of people don't understand the story. So the company failed by expanding too quickly in the US and Australia, but it's actually taken the decision to exit those markets. It's not costing them very much to close down those parts of the business. There's now a new chief executive in place in the form of Vic Darby. He's former managing director at moneysupermarket.com. So, very aware of kind of consumer-facing technology. The board's been refreshed with, people who have worked with Spotify and Just Eat. And there's four sources of growth as we see it. So the company kind of has about a 4% market share at the moment. They're targeting a 10% market share, and we don't see why that's not achievable. Ultimately, the secondary housing market volumes will pick up.
Income obviously is a big buzzword at the moment. You've also added a property fund recently. Is property an area you think could replace some of the lost UK dividend income we're being told about or we're actually seeing at the moment, or do you prefer bonds?
Yeah, so the property side of our portfolio, the income generation there has definitely held up better, which just demonstrates, the benefit of a multi-asset approach. Not only to income products, but to total return products as well. Because income is a very important source of return as well as capital growth. But I'd say that's maybe more specific to our portfolio than the property sector in general. And that's because we take a very targeted approach. So we're not looking for just generic, broad property exposure within our portfolios. We're very deliberately targeting specific niches. So that might mean GP surgeries, for example, in the form of Assura, a holding that we have, or distribution assets in the form of London Metric. So I mean, by distribution assets, I mean kind of properties that are involved in logistics and the fulfillment of e-commerce, basically, which, as you can imagine, has been a beneficiary, actually, of the pandemic. And we also added a new holding recently, that you alluded to, which is LXI REIT. So the acronym LXI effectively stands for long indexed income. So what does that mean? That means that the typical tenant who's in the property that's owned by the REIT is locked in for around 20 years. And that they're paying a healthy rental stream. Almost all of those rents either move up with inflation or they have built-in increases every few years.
And just lastly, we've obviously talked about the benefits of the multi-asset nature of the portfolio, and we've talked about your view on the sort of recovery. You have about 7% in gold and gold miners. Sorry, is this because you're worried about the outlook to some degree, or is it a hedge? How does that position fit into the portfolio as a sort of a combination?
Yeah, no, good question. So we had the position before going into the pandemic, and it's certainly served us very well through the crisis, and that's basically because of what you touched on. Is it a form of hedge? We kind of view gold and gold miners. To be clear, gold miners typically, if the gold price moves up, gold miners will typically, outperform. But it does work both ways. So if the gold price falls, gold miners will typically fall by more. So we do think it's important to kind of have exposure to both. And obviously gold miners can move a little bit with broader equity markets as well in the short term. But yeah, we view the two combined as a pretty defensive part of the portfolio, really. And a beneficiary of a flight to safety against all sorts of potential crises, not least, a global health pandemic. So it's been a very good diversifier for us. It's also, a kind of hedge against further monetary debasement. So, i.e., central banks just printing more and more money, which ultimately could create inflation. And yeah, equity markets have bounced back quickly. We added to them quite significantly during the downturn. But, that's not to say they won't fall back again. Personally, I think they've probably bottomed, back in March. They'll probably continue to be volatile, but there's, people talk about, FOMO, basically fear of missing out. So anyone that didn't put money into the market back in March, April, when markets were very, very cheap and had fallen considerably, they'll be desperate to get in should there be further weakness. So I suspect the equity market will be reasonably well supported, and especially now there's increasingly aggressive central bank policy as well. So, and going back to your question about the corporate bond space, it was only the other day that the US central bank, the Federal Reserve, said that they would start buying US corporate bonds. So, you should start to see corporate bonds performing quite healthily, really.
That's great, Mark. Thank you for joining us today.
You're welcome. Thank you.
And if you'd like to learn more about the Seneca Diversified Income Fund, please visit FundCalibre.com. And while you're there, remember to subscribe to the Investing on the Go podcast. Please note that these are unprecedented times and markets can react very quickly to news. The views expressed are at the time of recording and could change. And remember, we've been discussing individual stocks to bring investing to life for you. It's not a recommendation to buy or to sell. The fund may or may not still hold these stocks at your time of listening.